All right. So sorry for the delay in getting out last week's lecture. The video file sometimes just gets corrupted and needs to be redone. Anyway, we shouldn't have any problems tonight. This is going to be talking about mutual funds. So, like I say, mutual funds are it's not that tough a concept, and they're pretty user friendly, and they're probably something when you talk about getting involved in the stock market and equities and things like that. This is probably the most useful way for you to be involved rather than owning individual stocks and doing, market timing and trying to pick companies and stuff. You are probably will be much wealthier and much happier and not have to spend as much time with it if you involve yourself in mutual funds. And mutual funds typically are composed of equities, shares, stock in companies, and you'll be able to prosper. Also, there's so many selections you can pick, whatever field. Now you shouldn't just do it based upon emotion. You should do some research, but if you have some knowledge and have done some research and you think in a particular region perhaps is going to do well or particular sector like defense or aerospace or medical or something's going to do well or also there's socially responsible funds that you have to be very careful because sometimes it's just marketing. They'll say things like whatever, zero emissions or something, knowing full well that for example, like an electric car is obviously there's a power plant off somewhere running on coal that's probably powering that electric car, but don't need to go there. But anyway, this is what you're trying to jump into. This is what you're trying to harness. So you can see those numbers across the bottom are, the start of last century and going on into about 2015. And yeah, if you're just going to try and jump in at any one point, it might be a little difficult. But all you need to do is take advantage of that trend line. And if you look at that, that's going to be about 10%. And that's just across the board. The Dow Jones Industrial Average is just an index, it's just a selection of a bunch of companies. And there's probably better indexes to be involved in, to tell you the truth. But anyway, getting involved in a mutual fund or something like that, you would expect to have that type of performance, if not better. So realistically, 10% per year is not that unusual, and in fact, that's the consistent average over time. So um, background on mutual funds. So stock mutual funds, which are the typical thing. Um, what they do is they buy a bunch of shares, they have them in their portfolio, and they basically, for lack of a better word, kind of blend them together. And com- this comprises a new product that they assess a price to it. They call it a net asset value NAV. But anyway, it's not a big deal. It's just like a share price, and that share price would be derived by looking at all their positions, how much of each share they have and the price of those shares, and a lot of math. And that's why they only calculate the price on mutual funds typically at the end of the day. So um, these are not meant to be, traded, intraday or whatever. These are more buy and hold kind of vehicles. Bond funds, yeah, they could be made out of bonds. And again, the same thing that holds true for bonds, where bonds are not probably a great investment right now and for the foreseeable future until interest rates change. That's probably still true. But the thing also you're looking at is that third line about professional portfolio manager. Now you know for yourself that you've read the or listened to that podcast about some of these portfolio managers who buy and sell, and so make your own decisions on that. But if you do have some of these managers who have got a good track record, and if they do, it's like a big time coach or something. They're get a pretty good salary because they're have proven talent, but make sure they do have talent. So The way you'd evaluate this are things like Morningstar and some of these other mutual fund, analysis kind of tools, third party people who do that. The one thing you want to be careful of, just like, underlying stocks, is that you want to be careful about past performance, being your sole indicator. You're hoping the price is going to go up. The fact that it went up a whole bunch last year um, may or may not be indicative of future performance. So that's something to think about. Let's see. Motives for mutual funds. Yep, small initial investment, easy to deal with. Stocks used to be a little bit more awkward because you needed to deal with brokers, you had commissions. Now that the commissions are so low and the brokers are kind of out of it, that everything's become automated, that's not a big deal. So there's that NAV I was talking about, net asset value. Yeah, they make it sound just like stock prices, but it's really derived from the underlying securities. Open end versus close, and I'm not going to spend a bunch of time on this. Not a big deal. There's some mutual funds that charge a commission that comprise now about maybe 3% of the total mutual funds out there, and there's 97% that don't charge a commission. So which ones should you get? The ones that don't charge a commission. Those would be called no load funds. And also these open versus closed end funds. Sometimes you have mutual funds that, let's say they're trying to, do these strategic moves within a market. Well, there's certain funds like Fidelity Magellan was just a monstrous fund. Years ago, it was such a monster. It was just the elephant in the room. And when they would take a position in a company, it would just distort the stock price. And they were just such a behemoth that it didn't make sense. So sometimes they would close funds and other things. But anyway, for the most part, you're looking for open funds with no load. Yeah, we're not going to spend a lot of time on this because they're getting down in the minutia. And again, if you're buying good quality mutual funds, you're not running into these situations. Load versus no load. So that's what you're looking for. No load. Loaded, if you're dealing with some salesperson who says, "Oh, this is the fund you need to be in," well, obviously he wants a little something for the effort. And the problem with that is, time value of money, right? And they're going to take their commission up front. So even though their commission may seem like a reasonable percentage, that whatever percentage, those initial dollars that they're taking, that's very painful because those are the dollars that are going to grow into massive amount of money, later on when it has 40, 50 years to work. So here's an example. Invested $5,000, all 5,000 went into the fund, and prices. Here's a 10% return. Now here's one with the loaded fund, right? They took $200 off the top, and this guy got a 10% return. With this load being assessed, you can see just that small amount took the return down to about half. So anyway, expense ratios. Some of these companies, portfolio management fees, other things. It you know, it depends on the market, but in many cases, as things document, sometimes management fees are not worth it. An average expense ratio may be a bit too much if they're not getting the performance. I don't mind being charged a fee if there's, um, substantially above average performance. But if they're just getting mediocre results, they don't deserve it. So funds with lower expense ratios. So that means that uh, anyway, that what they're saying here is that most of these managers aren't worth their pay. So because the fact that lower expense ratio is compensating, making up for the fact that they aren't earning their pay. So growth funds, when you're younger and have more time in the market, it makes more sense to be in things that involve a little bit more risk because your yield will be higher. And if there is a burble, a bump in the market, which there always are, um, it's not a big deal. You're not withdrawing this money in the next, few years. So a lot of times, growth and capital appreciation ones would be, um, you know, ones that are expected, the price is expected to go up quite quickly. So they'd be composed of, maybe high tech firms, and growth funds would probably be smaller emerging companies, that involve more risk. Things can go sideways. But the fact that you've got a whole bunch of those type of companies does sort of well, not sort of, does diversify your risk. So that's good. Small caps, when they talk about capitalization, they're talking about how much money the companies have. I can give you the numbers, but it's just sort of arbitrary numbers. But a small cap would be a small company, and a mid-size would be a larger, more established. And then here's an equity income fund. That's you can see they kind of quit with they went small, mid, and then they jumped into equity income. They didn't necessarily skip large capitalizations because typically firms with large capitalizations with lots of money that are through the growth phase typically need to pay a dividend to keep investors interested because their chance of their stock price going up very much further is doubtful. So, and then balance growth. So you can combine these things any way you want. I'm not so interested, like I say, in big companies, and I'm not so interested in dividends. But it's different strategies for different people. Sector funds. Sectors can be anything. It can be geographical sectors. It can be, you know, technology type things like we've talked about. It can be anything. It can be ethically whatever. It can be any um, sector they choose. Index funds. These are the ones with not a lot of management. They just buy across the whole indice a few shares of each of the companies in the indice, and they buy and hold, and things get pretty boring. International funds. So there's a difference between international and global. International means outside of the U.S., so it can be any company except for the U.S. Global can mean any company, including the U.S. And then socially responsible is what they're calling this one. But anyway, there's lots of firms or lots of different funds out there, and again, they're trying to come up with a name that they think is appealing because it's really all marketing when it comes to that. Other types, yep, small growth. ETFs, exchange traded funds. These are kind of a blend. What they want to do is they want to give a little excitement back into the mutual fund, and they trade these things on the exchange because the exchanges kind of feel like they're maybe being excluded, and so they want to get in on the action since so many people have mutual funds, and they'll allow the fund price to change through the day and other things. And anyway, different firms will also offer this. But I'll show you an example here in a second of a firm like, say, Ameritrade that has everything. So, and I'm not just trying to push them, but for some people it might be important because Ameritrade is one of the few that has a local branch, or at least they did here in Anchorage. I guess it's moving, but anyway, I've got some money with them, and they're just fine. And it is kind of nice to, if you have a check, to be able to walk into their office. But wire transfers and um, just plain old bank transfers work just fine as well. So Vanguard's one company. I'm going to show you another one. We've looked at Vanguard before, and Vanguard, I think, yeah, Vanguard was the one that we were talking about with the um, podcast assignment. But you can get the same information from pretty much any of these companies. Types of mutual Okay, now we're moving into bond mutual funds. So treasury bonds, Ginnie Mae, things that are tied to mortgages, and corporate bonds. So corporate bonds are going to have to pay a higher yield a little bit because unlike the government, they don't go out of business. Or corporate bonds can go, corporations can go out of business. Therefore, your um, bonds could be at risk. Junk bonds, no need to go there, but be careful. They won't call them junk. They'll call them high yield or something like that. And then also we know from what I was telling you about where you get a whole bunch of junk bonds and you put them together, they don't become better. They're still junk underneath, and that's what happened in the 2007 crisis. Mutual munis, people generally get involved in these because they're uh, you know tax reductions, mostly not subject to federal tax, but they pay a lower yield. So again, you've got to do a little bit of math, and there's a homework problem that we'll discuss here in the end. And index bond funds, same sort of concept with indices. International and global. So here they make that distinction between international and global, and then the maturities. Return from a mutual fund. So just like a stock, it can be one that pays a dividend, or it can just be, buy low, sell high. Um, Sometimes they're distributed, and sometimes, if you so if internally the portfolio manager, you know, makes a sale of some stocks, you might make some money that way, or this last one, you just flat sell the shares. But and there's usually a little box there, if capital gains, if there is a capital gain distribution that you typically what I always do is just have reinvested in the fund. If you don't do that, then they may send you a small check, and your goal here is to invest money. So if they're paying you money back, anyway, it doesn't make a lot of sense. So here's a couple of mutual funds, index one and a technology mutual fund. So obviously technology, not paying a dividend, trying to grow. This one established, paying a dividend, short-term capital gain. So this one, the stock price didn't appreciate much, as in nothing, zero. This one went up 900 bucks. Long-term capital gain, 200 bucks. This one just 100, but it did 900 short term. Total income, and the taxes on the short and the long are going to be a little different, and the after-tax income. So in this case, they're showing a higher result due to the difference in taxes. But um, probably not the best example. There's no need. I mean, the manager knows what he's doing when he's selling short term. Um, he could have kept it just a little while longer, or maybe he had a good reason. But anyway, risks. So market risk, obviously, the underlying stocks. But again, you're buying some diversity. If you're invested in, some technology fund, and whatever is going to be the next best big thing, you may be um, right on that. Let's say you're picking an individual stock, and you say a certain technology is going to take off, and you pick the one company you think that's going to profit from this. Well, you had to make two correct choices there. Number one, the right technology, and number two, the right company. If you're doing a mutual fund and they own a piece of all of those companies, you only needed really one correct answer. Now, again, your potential upside, um, you know, it's like roulette or something where you put a whole bunch of money on a single number versus just picking red or black for the gamblers out there. Conservative stock index fund. If you go with a conservative fund and you're young, probably not the wisest thing to do. You can take a little bit more risk because in a conservative fund, it is going to have limited return, limited risk, and you're shooting for creating wealth. Um, Inflation's always going to be a thing, and if you're not in the game, anyway, people at least student wise, they never seem to want to take any risk, and it's unfortunate. There's money to be made out there. Moderate, so a growth stock fund, and then a growth stock fund in the single sector. So it gets more selective. It's a little more complex than this, but anyway, mutual funds you can do quite well, and there's a lot of publications out there that will show you some of the past performance. That's a good place to start. Again, it doesn't indicate future performance, but maybe you can see what what gave them that great performance, and if those things are still aligned, maybe you can expect it to happen again. There are some funds out there, and again, Warren Buffett, with his Berkshire Hathaway, he got outstanding results year after year after year. So it can happen. Risk from a bond fund, obviously the companies can go under, or it can be one where the interest rate can no longer may no longer be competitive. So, and then if it's a business, it company just might default on you, go out of business. All right. Risk and return of a mutual fund. So they're showing an index fund, but there's different indices out there. There's some very conservative indices, and then there's some indexes that are just made of, some sort of high tech thing. So there's never absolutes. Income funds, big companies that are paying a dividend. That's probably wise where it's put. Balanced, kind of wishy-washy. Growth, capital appreciation, global, and then foreign. I don't know. I don't own. Well, I do have some Chinese stocks or Chinese technology, and it hasn't done real well because you're when you go with foreign investments, you're have to have multiple things go in your favor, and now you have diplomatic issues, and you also have, in this case, technology, and uh, had one but not the other. So bond funds. So long term T. Anytime you go long term, that's a big commitment. Short term, less time for things to go wrong, so a little lower risk. And here, down in the high category, short term, high yield. So the only makes this in the low category is that they're short term. But here, when you go long term, you're really playing with fire. Long term and a high yield, long term junk bonds, pretty risky. Interest rate movements and longer term bonds, sensitive. Trade offs. Yep. I've never really invested in junk bonds. Um, I've definitely done some high risk stocks, and for the most part, they haven't worked out that well. I definitely go towards the higher risk, but I don't go for the riskiest. And the conservative things, these aren't going to probably keep up with inflation. This is, I would use as sort of a parking place till I found an investment that was worthy. So short term, same things apply. Backed by government securities, treasury bonds. Here they are. Long term exposure on a foreign country. Yeah, that's how that's going to work. It used to be thought that these mortgages, absolutely not a problem. Nobody's going to default on their houses. And they come to find out that it wasn't your typical, single family home people. No, it was some dude working in a video store with 5 mortgages back in the day. And anyway, for him to default was not a big deal. So selecting a mutual fund, objectives, your risk tolerance, how much risk, can you still sleep at night? Fund characteristics, and the prospectus. So the prospectus are sort of the handcuffs that are put on the fund manager. It'll tell what he's going to do. It'll also have those expense ratios in there and performance as well. But you'll be able to read in there and find out um, what types of investments they can be. And then also you look at the underlying stocks that are composed. It's kind of funny. I had quite a few different mutual funds, and I thought I had a fair amount of diversity. And then, for example, I found that Apple and Google were, major components of all these different mutual funds that I had. So I really didn't have much diversity because the underlying assets, the positions they held with these companies were all the same. So they all did well, but I didn't achieve much diversity by having, you know, different mutual funds with different names on them. Again, there's a lot of research, a lot of due diligence you need to do to figure out which fund's going to work for you. And doesn't hurt to sort of start small and take an interest and find out, how the whole market operates before you start putting in larger and larger sums of money. And mutual funds are good in the fact that you can start with very small amounts, $50 a month. And a lot of times they'll have a minimum to establish an account. But if you commit to, say, something like $50 a month, they'll waive that minimum to get into the fund. So fees, back end load. Back end load that's kind of interesting. What happens there is the commission's taken out at the end, which I don't see a reason to pay a load from the get go. But if they do want to charge a load, to take it off of um, the results means that they have a little skin in the game there. The better the fund does, the more money they make. So they'll try and assess the risk, and if you're somebody who's a official in a publicly traded company, and you fudge the details here, or you say, oh, it's no risk at all, and it's risky, and Securities Exchange Commission, and you can go to jail. So there's a lot of things that will happen with stocks, and you'll see this happens to Apple every year where they get kind of beat down because they can't make any public disclosures within 30 days of their SEC filings. So their competitors will say things about their company and they can't respond to it, or you'll hear, some official of a publicly traded company getting in legal trouble, to include jail, if they misrepresent the health and the position of the company. How to buy and redeem. All this has gotten quite easy with the internet. So again, they have some tables, but they mention Fidelity. Fidelity's a good company. I have the University of Alaska is associated with them, but they have a range of companies that you can deal with, but they're just fine. They don't have a local presence in Alaska, but that doesn't really prevent you from you know dealing with them. Quotations. The best place to do this again would be online with an interactive chart. So all these numbers and stock tickers, that's just kind of silly. Yeah, all these numbers are meaningless without comparison, so of little value. Charts are available for all of this and for free. So this thing paid a dividend. Last price, it's up 17 cents from the day before. Lipper indices. Again, Morningstar is really the company that you typically deal with. Morningstar has rankings. They have rankings of the funds, and we'll take a look at that. Typically, you can act, Morningstar is a commercial company. They sell their data. They don't necessarily give it away for free, but if you have an established account with one of the brokerage firms, then you can get a lot of the information as the brokerage firm is paying for it. If you get information for free, it's generally, worth what you paid for it. But if you have an account with them, then Morningstar or whoever is being paid by the company, and it's a benefit to you as a customer. Mutual Fund Education Association, that's fine. I don't spend too much time with them because the actual commercial companies, they tend to be fairly honest and give you the information, but that's an option. This is just a association of the different entities that sell mutual funds. Diversification. Best strategy diversified against, I would not. Um, I don't diversify just for the sake of diversity. If I know bonds right now are not a good thing, I'm not going to buy some just to have some. Um, and again, be wary of false diversification. You'll have a Fidelity emerging technology, and you'll get a, TD Ameritrade, growing technology or something. Anyway, you need to look at the underlying investments to find out what their holdings are. We'll go to a website and I'll show you in a second. Financial crisis. So these guys are still. Most mutual funds perform poorly. Yeah, but the next year they were up 43%. So over time, that's why I'm saying things. If you know don't have that appetite for a bit of risk, and you see your money dissolving because the market's falling, and you sell at the bottom, that's how you lose a lot of money. For most people, if it's truly retirement money, you don't need it right now, and the stock start falling, just ride it out. You're in it for the long haul, and you're going to be just fine. So, international diversification, it depends. There's more risks sometimes when you go internationally, and you know, you need a good reason to just don't do, international diversification for the sake of it. Make sure you have a valid reason why you expect those other markets to do better. Because right now with globalization, it's very, very rare for one country to be doing very well and the other countries to be doing great. So anyway, yeah, you'll see that in order, there'll be a Morningstar ranking, say that some particular fund is great, and you find it's not offered by the company that you're used to dealing with, that might make you switch and go to that other company. So you'll find that many of these big brokerage firms will actually sell some of their competitors' products just to keep you, you know, dealing with them as a company. They won't promote or push those funds typically, but you a lot of times can find them available. And it makes just the mail process at the end of the year and your tax filings just much easier when all your statements come from one company. And, if you're using a thing like say TurboTax or something like that, it's can be just a paperless download. When you get to that section of doing your taxes, you can download the tax information, and it pretty much fills out the forms for you. So it's quite nice, quite easy. So stock fund, U.S. stock market, corporate interest rates, euro. But when you start getting currencies, we take for granted, that currencies don't fluctuate much in the United States. They do fluctuate a little bit in Canada, but when you start getting some of these countries, I lived in Turkey for a number of years, and they would routinely collect up the bills and issue new bills with, more zeros on the end. It was just horrendous. You couldn't hold cash. So some of those other risks, you're going to invest in a company that's in a very high inflationary area. The company has to perform well, but also it needs to adapt to the currency risk. Sometimes it's too much. Hedge funds, they don't have to be just for wealthy, but sometimes some of these people will do some creative stuff, and I wouldn't put all of your money in those type of things, but there are some creative managers that can do pretty well, and it's not just for wealthy folks. Bernie Madoff, yeah, he's a scumbag. He took a bunch of people's money, but they were all getting, 20 some percent, and they thought they weren't exposed to any risk, and he was a pyramid scheme. He was taking in money and paying it out to the people who were already invested, and then finally when the new money quit coming in, everything fell apart and he went to jail. But homework. So this is interesting. This is what I was talking about with say a bond fund or a municipal bond fund that might be tax free and a fully taxable investment. And so in this case, a fully taxable investment that's getting 10.2% interest, is that better? Obviously 10.2 is better than 7.9, but this one, the 7.9 is tax exempt. Which one do you want? So how do you do that? How do you figure that? Well, it depends on your situation and you need to know your tax bracket. So in this case, you know that you can earn 10.2%, but since you're in a 28% tax bracket, you only get to keep a portion of that, right? You only get to keep 72% of that. So you multiply, um, we can just do that right now. Show. So we get a calculator here. So we had um, 10.2, and we know it's a 28% tax bracket, which means 78% is what you get to keep, right? 28% of it's going to go to the government. So times 0.72 equals 7.33 is your net. That's your actual amount you get to keep of that. 7.3 is less than 7.9. So in this case, the tax exempt is a better deal. And so that's what you need. You need these two rates. You need to know what your tax bracket is for that series. We've already discussed tax brackets, and that's how. So when somebody says, "Oh, I always want the tax exempt investment," what they're demonstrating is you know, they don't understand the depth of what they're talking about. They might be right, they might not be right. If this is only 7%, they're not right. So it depends on a number of factors. Here they purchased 100 shares at 42.50. Commission was 35 bucks. You sold the stock for 55 and paid a commission of 50. So number one, don't be paying commissions. Everything's free now. So this is getting to be an obsolete problem. And then they got a dividend of $50 per share. So anyway, you do all that math and you come up with a price. Interest rates in the overall economy decrease. What will happen to the market value of corporate bond? with the fixed interest rate. So if the interest rates in the overall economy decrease, the market value of your corporate bond. So your corporate bond would already be set. It would be established, right? And so the new bond offerings would be offering less. So your bond would be worth a little bit more. That'd be a good thing. But guess what? Interest rates right now are, freakishly low. They're down at a few percent, and so they can't really go any lower, but they can certainly go higher. So what can happen, what probably will happen, is just the opposite of this case. And anyway, it's not germane to this problem, but the reason why I'm saying I'm sort of down on, not sort of, I am down on bonds is that if you were to buy them today with very low interest rates and the interest rates climb, that's not going to be a wise investment. And here's just another word math problem. Not a big deal. Term project, just a reminder that it's out there. Again, tailored to your needs. If you have questions, send me an email. Let's look at just one thing. So again, I'm not trying to push these guys, but TD Ameritrade, one company, you can do anything. I mean, some of these things are stupid. I'm telling you, don't jump in with margin trading. Margin trading is using borrowed money for investing in stocks. And we talked about the whole problem with maintaining the collateral. You can get yourself into a lot of trouble. You could also do a futures thing where you could, you know, basically enter in a contract to deliver a whole bunch of fuel oil or some commodity and so they've got everything from wise mutual funds, conservative, they got exchange traded funds, they've got options, you know. So you could stay within a company like this, and they aren't alone. There's lots of companies that have this sort of broad range of services: IPOs, initial public offerings, annuities. Um, Remember when you give them a certain amount of money, they start making payments to you for as long as you live. So the longer you live, the better off. Managed portfolios, even Bitcoinish kind of stuff. Not sure which ones they do. Probably anyway. There's definitely a desire for these people to be kind of your one-stop shop. You don't need to go anywhere else. They don't want you going anywhere else. They want you to remain with them, and so they'll do that. But again, economies of scale, pricing, things like that are going to be. That's what I'm saying. No commissions. $5 to use a phone, and 25 to have somebody hold your hand. Fair enough, but maybe you're trading, big numbers, and you want that. But all right. So mutual funds, in a nutshell, let me do one more thing. Um, Morningstar, what I referenced before. What the hell's going on here? They are a company that I didn't spell that right. Close enough. Google figured it out. These are the guys who rate mutual funds, and they'll have some information here that's all right, but for deeper deeper analysis, you probably have to get behind the paywall. Morningstar Premium, and maybe the free trial might be enough to get you going and get you where you need to be. But these guys would provide the information in whatever format you want. It can be a chatty sort of, verbal stuff, or just ratings of index funds, for example. I mean, and again, they're not going to give away much for free, so that's not me fuzzing the numbers out. Now, if you do have an account with one of the other companies, Ameritrade or Fidelity or somebody else, you can probably get this information, and it would not be Obliterated like that. All right. Well, that's it for this week.